Most companies think they have data. They don't, and it's quietly costing them more than they realize. What they actually have is capital they never recognized, never structured, and never learned how to manage. And that mistake compounds, not gradually, structurally, because in artificial intelligence, data is not an input. It is not fuel. It is not something you simply use. Data is capital. And once that becomes clear, the economics of AI stop being technical and become financial. The shift is subtle, but decisive. Because the moment data becomes capital, every decision around it becomes a capital allocation decision. What to collect, what to ignore, what to structure, what to discard. These are not engineering choices. They are investment decisions. And most organizations are making them without realizing it. And most are not just mispricing these decisions. They are already absorbing the consequences. Quietly, in slower iteration cycles, in rising hidden costs, and in systems that appear stable but are already weakening. Most organizations treat data acquisition as passive, something that happens automatically as the business operates. Logs are generated, events are captured, information accumulates. It feels like collection. It is not. It is construction. And construction requires intent. This is where the first miscalculation appears. Because when data is treated as already existing, its cost disappears. And when cost disappears, discipline disappears with it. But useful data is never simply available. It is built, captured through designed systems, structured through enforced standards, labeled through funded processes, validated through continuous oversight. Every step consumes capital, time, labor, infrastructure. None of this is incidental. It is investment. And like all investment, it competes with alternatives. But most organizations never model that trade-off. They assume data acquisition is necessary, but necessity does not remove cost. It hides it. This is where most AI strategies break. Not at the model layer, at the capital layer, because data acquisition behaves like infrastructure: upfront cost, delayed return, uncertain utilization, no guaranteed payoff. It is capital expenditure. But it is rarely treated that way, which creates distortion from the beginning. Organizations assume the return is automatic. It is not. Most of the cost sits below visibility. Instrumentation must be deployed, pipelines engineered, storage scaled, labeling funded, quality enforced. None of this generates immediate output. They are the price of admission for a game most companies don't realize they've already started losing. What appears as model performance is supported by a layered capital structure beneath it, most of which remains unaccounted for. And because it is invisible, it is underfunded, not explicitly, systematically. Budgets prioritize visible returns. Data investment is not visible, so it is deferred. And that deferral is where the second failure begins. Because underinvestment does not fail immediately. It degrades silently. At first, nothing appears wrong. Models function, systems respond, outputs look acceptable. But beneath that surface, the asset weakens. Data becomes inconsistent. Coverage gaps expand. Edge cases accumulate. Label quality deteriorates. And the system compensates: more compute, more human review, more manual exceptions. Costs rise. not because the system grew, but because the asset eroded. This is the hidden feedback loop, and most organizations only see it when costs accelerate, not when the asset declines. Because data does not depreciate, it becomes irrelevant. A dataset can remain intact, accessible, and still lose all value. Because the environment it represents has changed. Customer behavior shifts, markets evolve, language drifts, the system changes, the data does not. And when that gap widens, predictive power collapses, quietly, then suddenly. And the asset becomes a high-fidelity map of a world that no longer exists. This is where the third miscalculation appears. Data is not a one-time investment. It is a continuous capital cycle. New data must replace old. Labels must be updated, distribution corrected, pipelines maintained. The investment never stops, which means the cost is not fixed. It is recurring capital expenditure. And when it is treated as fixed, financial models break, return projections distort, payback periods extend, profitability assumptions collapse, not immediately, but inevitably. This is not a technical error. It is a capital accounting error, and it propagates, because not all data investments succeed. Some never scale. Some are too noisy. Some are structured incorrectly. Some become obsolete before use. That capital is not just underperforming, it is stranded. It cannot be recovered. It cannot be repurposed efficiently. It remains, but no longer produces. And future investment must compensate for past mistakes. This is how costs compound without returns. This creates asymmetry. Because organizations that understand data as capital behave differently. They invest earlier, more deliberately, with longer horizons. They do not optimize output. They optimize asset strength. And this is where advantage begins. Two companies may deploy similar models, but the one with stronger data capital improves faster. Not because of better algorithms, but because of better assets. And that gap widens because data compounds. Better data produces better models. Better models generate better interactions. Better interactions produce better data. The system reinforces itself. This is not a feedback loop in performance. It is a compounding loop in capital. And once it stabilizes, it becomes difficult to disrupt. Because improvement is internal, not external. This is the AI capital flywheel. And this is where the divide becomes permanent. Because companies that fail to invest do not stay neutral. They become dependent on external data, on vendors, on shared infrastructure. And shared infrastructure removes differentiation. Competition shifts from capability to price. Margins compress because the asset is not owned. It is accessed, and access is always more expensive than ownership. You are paying for your competitor's capital to work against you, and over time that cost becomes structural. That structure does not remain contained. It expands across the organization. Decisions become constrained by external systems. Cost flexibility disappears. Strategic options narrow. What begins as convenience becomes dependency, and dependency, once embedded, is rarely reversible without significant capital loss. This is the consequence most organizations miss. Data acquisition determines who controls the economics, who owns the asset, who sets the cost structure, who captures long-term returns. and who becomes dependent. At the market level, this raises barriers to entry, not through regulation, through accumulated capital. Because high-quality data cannot be replicated quickly. It is tied to time, which means late entrants are not building systems, they are rebuilding history. And that is more expensive, which makes data both powerful and fragile. If pipelines fail, it degrades. If access is restricted, it shrinks. If behavior shifts, it loses relevance. And at that point, recovery is no longer incremental, it becomes structural. This is the dual nature of data capital. It creates dominance and exposure. Which means the question is no longer, how much data do we have? But what is the condition of our data capital? How it is built, maintained, compounded, and how fast it decays. Because organizations that cannot answer that are not just inefficient, they are misallocating capital. And that misallocation is not corrected by better models, it is corrected by the market. And once it compounds, it is not reversed, it is absorbed by competitors who understood it first. Because in AI economics, performance does not determine survival. Capital structure does, and data is where that structure begins.